Thank you for joining us at XM.com for today's market comment by Marios Hadjikyriacos. I'm Maria Pacherdabis. Shares on Wall Street reached a new all-time high last week as enthusiasm surrounding artificial intelligence went into overdrive, and another round of solid economic data reinforced hopes that the U.S. economy can avoid a recession. Companies with direct exposure to artificial intelligence, such as NVIDIA, spearheaded the rally. Investors increasingly view these stocks as bulletproof because even if the global economy loses steam, demand for AI products will still remain elevated, shielding corporate profits from any macroeconomic headwinds. Another element behind the blistering market rally was the Michigan Consumer Survey, where inflation expectations declined while consumer confidence improved significantly, painting a rosy picture of the American economy. The S&P 500 gained 1.2% to eclipse its previous record high set in early 2022. One interesting twist is that rising bond yields did not put the brakes on the stock market. Equities reached new records even as investors unwound some bets of rapid-fire Fed rate cuts, with the implied probability for a cut in March falling to 43%, down from nearly 90% last month. In the FX arena, the dollar was unable to capitalize on the encouraging U.S. data and fading Fed rate cut bets. It appears that the euphoria in riskier assets dampened demand for safe haven instruments such as the dollar, negating the boost from the interest rate channel. The next major event for the dollar and equities will be the release of U.S. GDP data for Q4 on Thursday. Gold prices have struggled so far this year, losing about 2% over the last 3 weeks, as the resurgence in U.S. yields and a firmer dollar overpowered safe haven flows stemming from geopolitics. A stronger than expected U.S. GDP print on Thursday could keep the precious metal under pressure. Over in China, the central bank kept rates unchanged today, despite mounting pressure to stimulate an economy that is battling deflation. The decision suggests growth could remain stuck in slow gear for some time, hence why local stocks tanked today, with Hong Kong shares reaching their lowest since November 2022. Looking ahead, the Bank of Japan will announce its next decision early on Tuesday. The yen has lost 5% of its value against the US dollar already this year, and the BoJ is unlikely to throw the battered currency a lifeline, as cooling inflation and a sharp slowdown in wage growth have convinced investors the central bank will delay its plans to exit negative interest rates. Thanks for watching today's market comment here at XM.com.